So in 2022, the UK economy is struggling with weak economic growth and one of the highest rates of inflation in the OECD. Now, some of these problems can be attributed to short-term problems like the end of COVID lockdowns and rising oil prices, which is causing cost-push inflation around the world. However, apart from these short-term issues, there are long-term challenges faced by the UK economy, such as the costs of Brexit, poor productivity growth, and a decline in competitiveness with our major trading partners. And a good place to start with the problems of the UK economy is looking at UK productivity. And as you can see, since 2009, labour productivity has almost stagnated, and it's fallen considerably behind the previous UK trend rate. So this means that the economy is much smaller than it could have been if that trend rate had been maintained. The UK is not the only country to have poor productivity, but the record of the UK is one of the lowest in the G20. Why has the UK had poor productivity? Well, quite a few reasons have been put forward, but certainly a lack of investment in new technology, a short-term approach to business, a short-term approach by the government to public sector infrastructure has led to an unwillingness to invest in new technologies that's leaving the UK economy behind. And this has been exacerbated by COVID disruptions, but the problem of productivity goes back before COVID and even before the Brexit vote. And as a consequence of this poor productivity, we have very low economic growth and well below that trend rate of growth we used to have. And the OECD calculate the UK will record the lowest growth in the G20, except for Russia, in the coming year. And with this low growth, there's less capacity for real wage growth, and it will hit government finances at a time when we need more public sector spending and wish to reduce taxes. Another big issue hanging over the UK economy is Brexit. The UK has left not only the European Union, but also the single market and the customs union. And this has caused considerable disruption to EU trade, which used to account for over 50% of the UK's trade. Now, in the post-single market era, firms exporting to Europe are faced with an increase in regulation, custom forms, charges such as VAT on delivery, all this making trade more difficult and expensive. The OBR claimed the effects of Brexit will cost the UK economy about 4% of GDP, which is equivalent to £100 billion in lost output and £40 billion in less revenue to the Treasury. Another think tank, the Centre for European Reform, models the cost of Brexit to be a shortfall of 5.2% of GDP. And unfortunately, with rows over the Northern Ireland Protocol ongoing, there's scope for continued disruption to EU trade and cooperation with our European partners on things like science. Now, it was hoped that Brexit would lead to new opportunities, for example, free trade agreements with non-EU countries like Australia and New Zealand. But unfortunately, many of the new trade deals are not a huge difference to what we had when we were in the EU. But also, there's a limit to how much you can switch trade with your closest geographical neighbours to people halfway around the world. And the gains from liberalised trade with non-EU countries is far outweighed by the loss to the biggest single market in the world on our doorstep. Another impact of Brexit is the loss of migrant flows from the European Union. This has led to considerable labour shortages in areas such as lorry drivers, fruit pickers, hospitality and transport. And labour shortages have led to the queues at airports and at Dover docks we've seen recently. And the chief executive of EasyJet, Johan Lundgren, recently claimed that 8,000 EU job applications were rejected because they could no longer work in the UK post-Brexit. Now, it is worth saying that labour shortages we see all around Europe is not just a Brexit issue, but definitely it has worsened the problem, especially in areas where we used to rely on EU migrants. Another problem for the UK economy is a rising tax tax burden as a share of GDP. You can see that since 1993, the tax burden has risen quite significantly. But the problem is that there hasn't been any strong dividend of higher public sector investment. The rising tax burden really highlights the weakness of tax revenues and the need for higher government spending on COVID bailouts, healthcare, and spending on welfare. And the concern is that in the future, there will be an increased need for government spending on healthcare and welfare because of an aging population. And even though the tax burden has gone up, people still feel that public services are shortchanged, and there are long queues at the NHS, and public sector pay has fallen behind quite considerably. For many people in the UK, the problems of the economy really hit home in the fact that real wages have stagnated since 2009. In 2007, real median disposable income was $37,310. 13 years later, in 2020-21, there's only been a very small increase to $37,622. So less than 1% growth in real wages over 13 years. Now, it was hoped that Brexit would help push up wages, and in some sectors we have seen sporadic increases in real wages. But with stagnant productivity and a lack of bargaining power in many labour sectors such as the gig economy, real wage growth has been patchy at best. And this problem of real wage growth has been exacerbated by the recent cost-push inflation, which has seen the highest inflation since the early 1980s, with inflation now at over 9%. Now, whilst inflation is a global problem because of oil prices, the UK still has one of the highest inflation rates in the OECD. Despite quite weak economic growth, it's kind of like the worst of both worlds, a return to stagflation. And the knock-on effect of poor real wage growth is that it has led to industrial action, with workers feeling they can't meet the daily costs of living. So it started with train staff going on strike, but other sectors are threatening to join a wave of industrial action. And I think it's worth highlighting that the real wage stagnation and inflation is affecting people on low incomes more than those on high incomes. The people on low incomes with high rents are seeing an increase in the price of many basic necessities. And so we're seeing a further widening of inequality because the pressures from inflation tend to affect those on low incomes more than on high incomes. Since the Brexit vote in 2016, the pound has devalued by about 16%, and this has caused an increase in the price of imports and contributing to domestic inflation that we see today. Now, whilst a devaluation in theory makes exports more competitive, there's little sign of any prolonged boost in UK exports, partly because of Brexit. Now, a good example of how the devaluation has had an impact on the cost of living is how the UK is paying more for petrol. In 2008, oil was actually more expensive. It reached $144 a barrel. But in 2008, petrol was only 120p per litre. Now today, the price of oil is $111, so cheaper than 2008. But we are now paying at the pump prices of 200 pence per litre for petrol and diesel. Now, there are other factors behind the high oil prices. Oil companies are making bigger profit margins, especially at oil refineries. But devaluation and the weakness of the pound is definitely a factor in increasing the domestic cost of petrol. And unfortunately, the ongoing political uncertainty in the UK and a record current account deficit are putting further downward pressure on sterling, so things could get worse over the coming months. Now, despite a weakness in sterling, the UK current account deficit, which measures trade and exports in goods and services, hit a record deficit of 8.3% of GDP in the first quarter of 2022. Now, this record deficit is something of an anomaly in the sense that it's partly due to the high price of raw materials contributing to the record deficit. But even if we discount this quarter, the underlying trade deficit is a cause for concern, especially since the devaluation of the pound has done little to improve it, like you might expect. And the concern is that with Brexit, high inflation and low productivity growth, there's a continued lack of competitiveness in the UK economy with our major trading partners. In the past, the UK has been able to finance its current account deficit by attracting capital flows from places like China, Russia, Middle East, America, Europe. But since Brexit, the UK is seen as a less attractive place for capital flows. And if these capital flows do slow down, it will put further downward pressure on sterling. Now, it's not all doom and gloom. One success of the UK economy is one of the lowest rates of unemployment since the 1970s. And it's worth pointing out that it's been a testing time for every economy around the world, with COVID lockdowns and cost-push inflation. So given these challenges, it's unsurprising the UK economy faces many problems. But despite these short-term challenges, there are definitely concerns about the long-term future of the UK economy, with a lack of skilled labour, a lack of investment both in public sector infrastructure and private sector business investment. And if we cannot improve productivity and investment, then the UK economy will continue to fall behind our major competitors. So these are some of the problems facing the UK economy. If you have any questions, feel free to leave in the comments and I may make a video about it in the future.